Aussie homeowners are heading for this massive financial issue in 2023. Are you one of them? Now, if you have a fixed rate mortgage for your home loan, you could very well be one of these people heading for this dreaded mortgage prison. Now, especially if that fixed rate home loan is expiring in 2023. Hi, I'm Michael Sgarbossa, and welcome to my channel, Save, Invest, and Grow Your Money. It's a channel that I started for busy people who are looking for simple, actionable strategies that can help you build your wealth for you and your family. Anyway, what am I on about here? So, talking about what's going on here in Australia with home loans. So, the Reserve Bank of Australia estimates that about 23% of home loans are on a fixed rate mortgage that are going to expire in 2023. So that's massive. That's going to have massive repercussions for the housing market, for people's savings, for people's household expenses. So what that really means is anyone that's on a fixed rate mortgage expiring this year, you're likely to face a doubling of your mortgage repayments after that. So in two ways, you default to the standard variable rate of that mortgage. That is not the greatest rate to be on, and you're going to do whatever you can to not be on that rate. That's certainly going to double your mortgage repayments, I would have thought. But even so, once you renegotiate that onto a new interest rate off your fixed interest rate, there is going to be an increase. Now, whether that be with your current lender, for new lender, whatever, there's an increase that you're going to have to be prepared for. So 23%, that's a big number. That's almost 1 in 4 households that have a fixed rate mortgage. So that is massive. Now, I spoke a lot about what to do in last week's video if your fixed rate mortgage is ending this year in 2023. So I've left a link in the description of this video for you to go back and have a look at what I said last week about this and what to do about it. But I'm specifically talking this week about those who are going to end up in this mortgage prison, or what is otherwise called the LMI, or lender's mortgage insurance trap. So I'm going to unpack that a bit more for you today, like I said in last week's video, and what you can actually do about it. So now, what am I on about here? What do I mean by the LMI trap? So the lender's mortgage insurance trap is when you go to refinance your property and the loan to value is 80% or higher. Now, what do I mean by that? Well, firstly, it means LMI. If your loan to value is 80% and higher, and I'll explain that in a minute, but you'll be subject, if you're refinancing to another lender, you'll be subject to lender's mortgage insurance. Now, lender's mortgage insurance is expensive. I would go as far as saying it's extortionate. It's in the thousands of dollars. It's something you don't want to pay, and if you can avoid it, don't need to pay it either. So really, if you're caught in this trap, you actually really have about two choices. One is stay on the expensive standard variable rate that your fixed rate loan is going to default to, or get slugged with the lender's mortgage insurance and refinance to another lender. So that's, if you don't do anything, that's probably where you're heading. But there are a couple little things here we can do to get ourselves around it. So firstly, what is lender's mortgage insurance? And I explained this a little bit last week, I think. But lender's mortgage insurance is a compulsory one-off premium that you have to pay on behalf of the lender if your loan to value of your property is 80% or higher. Now, this is to cover the risk of the lender having to foreclose on your property if you stop making repayments on it, and especially in a depreciating housing market, which we're in at the moment. In some areas of Australia, housing prices are declining. Actually, many areas of Australia, not all, but many. And if you're caught in that trap where you can't make your repayments, the bank forecloses on you, they have to sell your property, it's worth less than what you bought it for, it protects them in that instance. So, the lender's mortgage insurance is not for you. It's really for the lender. It's for the banks. So don't be fooled by that. All you get out of it is having the ability to get a mortgage to buy a home if your loan to value is 80% or higher. That's it. So it's an extra premium to pay to get access to get you into a property, which is not necessarily bad, especially in an appreciating market. Now, how are you going to work out if this is an issue for you? Well, firstly, and this is how to work out your loan to value. You need to work out how much that you owe on your mortgage. So you can determine this a couple of ways. One, have a look at your mortgage loan account or your mortgage statement, and have a look at what the loan balance is on your loan account. That is how much you owe on your mortgage. If you want to do it more simply, and you know your account number, you can just ring up your lender and talk to them. It's probably going to take you a bit longer, but everyone has preferences on what they like to do. So that's two ways that you can work that out, how much you owe on your mortgage. The second part of this is working out what is the value of your home. Do you know the value of your home? And you probably don't. But there's a couple of simple ways it can give you an idea of the value of your home, but not an exact thing. So this is like an indicator to go, okay, am I heading down this path, or am I safe? Am I heading for something beyond 80% loan to value, or am I below that and it's not so much of an issue? Now, there's two fairly simple ways to determine the value of your home. One of them is go to a website called onthehouse.com.au, and that is a online valuation website for homeowners here in Australia. So you can simply go to that website, onthehouse.com.au, type in, search for your property address, for your home address, and voila, click the link and up comes your home, and it will give you a range in valuation of your home. So it's not a necessarily accurate valuation. What this website does, it uses the data of your postcode and homes around you that are similar homes or properties to your home, and it works out a range of what it believes your value is based on those properties. So that's one way to work it out. The other way, which is not particularly accurate either, is you can get on the real estate websites like realestate.com.au or domain.com.au. Both those websites have functions where you can see properties for sale or sold values. Sold values are particularly a bit lagging in there, so you could have a look at what's for sale now, because that might give you an indication of what the market is actually doing, and look for properties in your postcode that are very similar to the house that you live in, and have a look. Have a look. Try and find a number of properties that look like that. Have a look at the values of those properties. You might find that there is a number of people selling their home for around the same value. There's probably going to be some outliers, maybe some low ones, definitely probably a couple of high ones, some very optimistic sellers there. Don't pick those. Pick the ones where it looks like it's a more likely value, because if you go pick something high, it's pretty unlikely. And if you get a value or into value property, or the bank, if you're refinancing, sends a value or has a value or revalue your property, pretty unlikely it's going to value your property at the high end of what you're seeing on these websites. Very unlikely, I would say. So once you know that, once you know what you owe on your mortgage and how much you think your property is worth, you can work out your loan to value. So I've got a very brief example here, and you've probably already been looking at it on the screen. So let's just say you determine your home's worth about $700,000 and your loan balance is about $600,000. Go grab your calculator, type in 600,000 or 600, divide by 700,000, or 600 divide 700, doesn't really matter. It can be just 6 divided 7 even, and times that by 100, and that will give you a percentage. So in this case, 600,000 divided 700,000 times 100 equals 85.7%. Now that is your loan to value, and that loan to value is greater than 80%, which means if you're going to refinance with another lender, you will attract that dreaded extortionate lender's mortgage insurance premium. Okay, so now you might not quite be there. You might be well below that. So lender's mortgage insurance, if you're going to refinance, is not going to be an issue for you. You may be well above that and you can't do anything about it. So there are some other options we can look at there. Or you could be around that, but you're not really sure. Now, if you're skating on the edge of that, I would encourage you to act now. Actually, wherever you are in this, I would encourage you to act now, but it's particularly if you're skating on the edge, because property values are on the slide here in Australia and will continue in most areas for 2023. So what that means, if you're on the edge now and you wait a few months, it could be then that your property becomes less than value, which will increase your loan to value. So you might be at 78%, and in 4 or 5 months' time, that might end up being 82%, and all of a sudden, you've slipped into the LMI world. Now, LMI is on a sliding scale. If you're just over the trigger point of 80%, the premium's not as big, but if you're a long way over it, the premium gets much larger, much quicker. But still, if you can work out a way not to pay it or do something now to avoid that, you would, wouldn't you? Absolutely. So really, I encourage you to go and do this. Act quickly, act now. Check this out. All right. So what do you do? What do you do from this point onwards in regards to your loan, your fixed terms expiring? Looks like you might be heading for this lender's mortgage trap. The first thing I would do right now is contact your lender or your mortgage broker if you use one, or a mortgage broker if you haven't used one before. Now, your lender or mortgage broker will discuss with you what your options are when your fixed rate expires, or what your options are to do right now in regards to what I've just indicated. Now, your goal is to renegotiate your fixed rate mortgage when it ends to a mortgage product that will be less than that standard variable rate that your fixed loan is going to default to. Okay, it's not the most affordable rate. You could be facing anywhere between 3 and up to 3 to 5% increase. So you might be looking at a 7% loan. Your repayments are going to go up a lot, probably double, probably more than double. Now, it may mean that you have to end your fixed rate early, such that you're in a better position with your interest rate later in the year and your repayments later on. So that's something that you need to discuss with your lender and mortgage broker. They'll help you through that. But do what you can to avoid ending up on that mortgage standard variable rate at the end of your fixed rate mortgage. Now, I do have another video on this where I go into detail on how to have this conversation with your lender and renegotiate your interest rate and your repayments ultimately. So I'll leave a link to that video in the description of this one as well, so you can go and check that one out as well once you're done here. I think you'll find that pretty useful and very valuable, particularly if you're in this position. Now, if you're considering refinancing, you may also be caught not just by having to pay a lender's mortgage insurance, but you may not even be able to get a new loan. And this is because you will be subject to meeting more stringent serviceability tests to get your new loan approved. Now, what does that mean? Well, serviceability means it's what the lenders do to assess your income to determine the loan that you can afford. So at the end of 2022, APRA, which is the Australian Prudential Regulation Authority, increased this serviceability stress test from 250 to 300 basis points. Okay, so what does that mean in real terms? It means that lenders now add a 3% interest rate buffer to the assessment of what you can afford for a home loan, as opposed to 2.5% buffer as it was previously. So the loan you're assessed for and what you can afford now is less than when you originally attained this loan, or likely less, particularly if it is in the last couple of years. That's if your income hasn't changed. So that's a bit of a shock. You might have got this loan 2 years ago. Maybe your income, maybe you've just had the same income. You haven't had a pay rise or a very little pay rise the last couple of years. You knew what you could afford then. You go to get a loan, and now they're telling you that you can't afford the same loan. That's a very real situation you could be facing, absolutely. So beware of that. Okay, so now if you can obtain that new loan and you are 80% above 80% loan to value, you will have to pay that dreaded lender's mortgage insurance premium, without a doubt. Now, something to watch here. So very commonly, lenders will give you the option or even encourage you to capitalize this against your loan. So what do I mean by that? In other words, it means add it to your loan. Okay, so simple as that. Now, right now, at this point in time, it may seem a great idea. Wow, okay, I don't have to pay that right now. I'll just add it to the loan and we'll worry about that later. All right, but if you go and do that, okay, all you're really doing is rolling a snowball downhill. And what does a snowball do when it goes downhill? It gathers more snow and it gets a hell of a lot bigger quickly. So what will happen is you'll end up paying interest on that LMI premium over the life of the loan. Now, that already extortionate LMI premium that you pay will end up being 2 to 3 times greater because of the interest that you pay on it. So when you consider this overall, from an overall cost perspective, it's probably not the best idea. It may even be worthwhile if you're really stuck and your lender's not really coming to the party with negotiating a new rate for you. Just toughing it out on that variable toughing it out on the standard variable rate if you can't negotiate from that, or the best variable rate you can get with your current lender. Now, you'll have to just tough that out until the financial markets and the value of your home are in a position that you can actually do something about refinancing, and that may be a couple of years. So you really need to have a look at your household expenses now and get prepared for what may be coming. So anyway, I hope you've gotten a lot of value out of that today. Went into a lot of detail. Might be worthwhile rewatching this again. I've got those other video links in the description below this one that help you along this path as well. And there's also those couple of websites that I referenced to help you work out your loan to value. So thank you very much for your time today. As always, I enjoyed talking to you. I enjoyed sharing with you this detail. I think everyone needs to know this and gain a little bit more information around their personal finances and how to manage it. Please subscribe to my YouTube channel, like this video, share it with those who you think will get value out of this video as well, and have a great week. And I can't wait to speak to you again next week. Cheers. Bye for now.